Now, what is more important is, what is a requirement for a valid insurance contract? A valid insurance contract will require that a person must always be honest at all time, and there will always be insurable interest. I want us now to look into those requirements, most important requirements of a valid contract. The first one, we started by saying good faith, and the two parties must always disclose. Good faith means you must always disclose all relevant information so that the insurer might be able to calculate the correct interest and the correct amount of premium that is supposed to be paid on monthly basis. Now, insurable interest is another requirement. You cannot insure something that does not belong to you. Insurable interest, I said in the previous slides, there must be an object of which, if the object is destroyed, you will suffer a loss. So that simply means you've got an interest in a particular object, and therefore only if the object is destroyed, then you might be able to gain out of that particular object. So insurable risk and non-insurable risk. Insurable risk are the risk that derives a financial benefit from the existence of an object within which you insure it. This is insurable risk. There must be a financial benefit to that particular object in case it is no more there. If it exists, there is a financial gain for you. So you insure that particular object so that when it is no more there, still there will be a compensation for it because you are gaining from that one also. Number two, insured stand to lose financially if goods are destroyed or by the death of a particular person. In this practical example, we talked about co-owners, we talked about partners. If I am involved in a particular business with a particular partner, if the partner dies, I may suffer losses as a result. So this is a practical example. Death of a person, then you will be able now to be covered also on that one. This is insurable interest. Examples could be multi-peril, fire insurance, asset policies, personal property policies also. These are the policies that could be taken out under insurable risk. Risk that are exposed, or those risks that we are always exposed to, and then there will always be uncertainty about them. We are not sure about the risk. There will always exist an uncertainty also. We are not certain about the outcome that will be there. We are not certain about the damage that will happen, how much it will cost. So there will always be uncertainties, and as a result, we need now to take out insurance for the purpose of damages that we may not be able to afford at the end of the day. Non-insurable risk, a risk for which no insurance can be written. Insurance company may not agree to take out any insurance of this nature. Why? The chance of a loss is too much higher, or it cannot be accurately measured. Example could be pre-existing conditions may not be covered by some other insurances. The damage that could happen as a result of an earthquake, therefore insurance companies are always reluctant to cover for the damage because the damage could be disastrous or the damage could be too much. So the insurance company may not be able to cover that. Nuclear wars, insurance company are not really willing to take out those cover because this is a risk that is too high, that will cost the insurance company too much, and the insurance company may not be able to cover those are called now non-insurable risk. These are non-insurable risk, which is directly the opposite of insurable risk. So we must be able to distinguish between insurable and uninsurable risk. Some things which are very certain. We said on the insurable risk, things are uncertain. But here, things are certain. We know that if it happens, an earthquake comes out, then we know that this is going to be too much. Pre-existing conditions also. We know that if we are involved in this particular situation, if a payout comes out from the particular insurance company, it's going to be this much. We are certain that we know that a 1 million will come after a certain period of time. So we are very certain about it, and therefore we are not willing. Insurance company, they are not sometimes willing to take out a risk of that particular kind. Therefore, it is not a risk. They don't refer to it as a risk because they are, we know about it. If they know about it, then it's not a risk. A risk would be something that you are not certain that when it will happen, when and what type of damage could be there if it happens. Then that is basically the difference between the two non and insurable risk. The risk that could be covered and those risks that cannot be covered by any insurance company.